Hello, this is Brian Shannon from AlphaTrends.net. Today is Tuesday, the 12th of February, 2008. The market's closed, and we had a pretty volatile session here today. The S&P 500 did show a gain of $1.26 or 0.95%, but there was a little more volatility than the closing number would suggest. You can see here the market did close right around near where it opened this morning. We had a pretty good intraday sell-off. And you can see where the market came from. First of all, it did get above this little level of resistance and what was looking like a neckline for an inverted head and shoulders pattern. It rallied off of yesterday's highs, gapped up, ran quickly, as I'm sure a lot of shorts got squeezed in there, and then people began to realize why this market was up in a down market, I think, overall. And once this pattern of lower highs and lower lows came in, we had a quick, fearful sell-off right down to the level that that should have offered some support at 134. So it wasn't really a horrible session as much as it might have felt like one towards the end of the day, because we did see that the prior level of resistance right in here near that 134 level did act as support, and also that is the location of the rising 5-day moving average, and that's the key word there, is that that moving average is rising once again. If we look closer, you can see that we also got pretty good volume here late in the day, as it that's not quite up to date, as it rallied right up to this prior level of intraday support. And on my blog, I had posted another video outlining a short trade I had taken in, where was it? I guess right in here, and then I had gotten short once again right here using the SDS, the inverse S&P 500, and that's the chart for that one. We'll go back to the spiders though. But basically, from an intraday standpoint, you saw that we did have these lower highs in the S&P 500, and once this support gave way near 135, that's where the cascade really began. We had the heavy volume on this sell-off here, followed by light volume as it rallied back up, and then another leg lower. But then the buyers did come back in, weren't able to push it above this intraday level of support, and also the average person who participated on the long side in here today is losing money, as the average price that the S&P 500 changed hands was about 135.30. So the mixed signals continue to show themselves on across the various time frames. Larger term, of course, we're still in a bear market. That hasn't changed. That doesn't change with a couple days activity. We're going to need to see this market at least get back above that 141 level to consider anything for the long side other than very short-term trades. And the volatility is showing you that even the short sales need to be covered quickly. I was targeting for the short sale, and here's what I was looking at earlier in the day with that short sale. I was targeting the 2-day moving average, and you can see that, I'm sorry, 2-day VWAP. You can also see that we came down and completely closed the gap this morning before that market turned back around late in the day. So overall, this picture is looking a little bit better in the fact that it was able to clear this 134 level. That 134 level was tested and acted as support late in the day. Now that's going to be important going forward for tomorrow. I think they basically, we're probably below about 133.65 or so would be reason for concern, and that would then put this 132 level in jeopardy. So we have to just take it as it comes, and it's the intermediate term time frame is showing a little bit of signs of recovery, but again, you just can't trust it when you've got such a bearish picture here on the daily time frame. When you've got mixed pictures like this, you're either better off sitting on sidelines on the sidelines in cash, or reducing your time frame rather down to the shorter term time frames and taking advantage of some of these large and quick sell-offs. In this type of market that maybe is searching for some support, the volatility is high as people are very emotional in here, and that if you can keep a level head about it, there are some good opportunities to take advantage of intraday. I said the 140 level, but again, the 137 is going to be important as well. That's been an important number. It's also the what was it? This 137 was pretty much an important level over the last month or so. Looking at the semiconductors again is pretty much a waste of time. This is a busted market group that's in search of a bottom, and this bottom looks like it's going to take some time to heal, and we'll continue to keep an eye on it just to see if anything interesting happens, but no reason to belabor looking at it. The Russell 2000 IWM right in here, you know, again, we've got to still see. Yesterday I said in order for the market to think that we can find any intermediate term strength, it's going to really need to clear that that 71 level. You can see we came up and tested that 71. Prices were rejected from that. And, you know, bullishly, though, it came down to the 5-day moving average. That 5-day moving average is starting to show signs of recovery again. We still want to keep an eye on this trend line here. I think breaking this trend line and, you know, probably getting below $69 a share would likely bring us down to the next level of potential support near about 67.70 or so. And then if that fails, well, then we can look for the target from this head and shoulders pattern in here that would bring the market back down to, if it does it, down towards about that 64 level. And I drew that incorrectly, but don't feel like going back to fix it. The point is, though, you know, we have mixed pictures across multiple time frames. This is that trend line in here that if it breaks, then, you know, puts this level in jeopardy, and then next stop below there would probably be a test of this you know, the lows from mid-January, and I still think that's a likely scenario at some point for this market. It's not happening yet, but the thing that would negate that would be if somehow this market can recover and get above and hold above the 73 for more than a couple of days. Doing that, I think we would have to kind of reassess the overall bearishness of this market, but again, there are no signs that that's happening. We've just got mixed signals all over the place, and you know, until it becomes clearer, defense is the proper strategy in here. The Nasdaq was once again the laggard. It closed with a loss of 25 cents, or about 0.5%. On a positive note, though, it did close above that level that we've been looking at as priorly as this support in here, and then as resistance here recently. Of course, yesterday we got above that resistance level, and I said that, you know, rallies in this environment typically fail while the 5-day moving average is heading lower. Now that 5-day moving average is flattened out, this level of resistance looks like it's tested as support. The 5-day moving average is being tested as support. So 43.50 or so, breaking below that. That's what's going to turn me a lot more bearish on this market. You can see here on the 10-minute time frame, what we've been looking at is this pattern of higher highs and higher lows, and that pattern was broken midday right here, and that's what led to the sell-off, the sharp, you know, quick sell-off that led to a test of the 43.65, 43.50 level and that 5-day moving average. So there is order within all this what appears to be random chaotic trading. We did have a pickup in volume today, so that's not a good sign, obviously. We've got the 10-day moving average below the 20, below the 50, below the 200. They're all declining. We've seen a low volume rally up to the 20-day moving average, and a little bit of selling come back in today with heavier volume. So, you know, it's still the buyer's game it's still, the sellers are still in control, basically, and it's their game to lose at this point. The market trend is lower. It should be considered guilty till proven innocent. You don't want to be too trusting of any of these rallies, these rally attempts, and you can take advantage of them because, I mean, here's 2 points. That's in this market, that's about 5%, a little less than 5% that the market rallied. Now it's back to the downside, so it's a great time to be a trader, but the longer-term trends are still lower, and odds favor continued downside.